Good evening, everyone. Welcome to our Bay Area focused home buyer workshop. My name is Jason Maida. It's great to be with you. I'm going to be your facilitator for tonight's class. And what we try to do is make these classes super interactive. So as we roll through tonight's content, we encourage you to ask questions. As we hit on a certain topic, feel free to use the chat or Q&A function. And then what I'll do is I'll answer those questions on air. Our goal tonight is just to be able to help bring you some information to help guide you on that path towards homeownership, so you can get tools and resources to help you on that journey to hopefully obtaining home ownership. Just a little bit about me. So I'm a branch manager here based out of Sacramento, but we lend nationwide. Most of our focus is on the West Coast, and our specialty is really helping first-time home buyers achieve home ownership through our educational platform. You're going to hear me talk a little bit about assistance programs tonight. So if that's of interest to you, we're definitely going to focus on some of that a little bit tonight. Here's our talking points for tonight's discussion. We're going to look a little bit about the housing market. We're going to do some budgeting, talking a little bit about what does it look like to go from renting versus buying and kind of how I build that budget for myself. We'll look at credit and then student loans and how that can potentially impact your qualifying. We'll spend some time looking at loan programs, discuss some of the documentation needed for your home purchase. And then one of our more popular parts of the conversation usually comes around various down payment assistance programs that are available. We're very privileged to be able to partner with CalHFA, which is the California Housing Finance Agency, and providing first-time home buyer programs across the state. And then I'll wrap up tonight's discussion. We're going to look at the loan process. What does it look like to go from being pre-approved for your home purchase to getting the keys to your house? We're going to walk you through our 6 steps of home buying as part of that. Talk a little bit about a consultation and how we design home buying plans for our clients and get them in a position where they are pre-approved. Okay. So again, this is going to be a very interactive session tonight. And so as you have some questions, feel free to go ahead and chime in. Love to be able to answer those on air for you. Okay. So, when we think about home buying, it's probably going to be one of the largest purchases we make in our financial futures. And there's a lot of great benefits that come with owning a home. The ability to create stability in your housing budget. Don't have to worry about maybe your rent increasing over time. This is still an asset, so you have the ability to be able to pass along this asset to the heirs of your estate. Home equity is created by appreciation of your home value. And then that difference between what you owe and the home appreciation is called equity. And, over the last 2 or 3 years, we've seen all-time equity rates. The market has changed a little bit, but nonetheless, especially in our Bay Area markets, we've seen a lot of huge equity growth out there. And there still is some great tax benefits that come along with owning a home, especially with mortgage interest. And so as we're designing home buying plans for our clients, the first place we kind of start off is looking around at budgets and figuring out what it looks like to purchase at kind of looking at some options to purchase, but what does that look like when I compare it side by side on a monthly budget? So what I'm going to walk us through now is our budgeting tool that is brought to us by Freddie Mac. Now, all the material that we review this evening, I'm going to send out to everyone tomorrow morning. In fact, it's going to come from Ken Fleck, who is helping us out with some of our Q&A tonight. So you'll get all the deck material or the deck page and all the material tomorrow via email. Okay, so let's go ahead and build a rent versus buy scenario. And let's start off with kind of just plugging in some rental figures. So we'll kind of do this a little bit on the fly here for tonight's discussion. So let's say if I'm paying in monthly rent $2,500, I want to also assume that I have renter's insurance in that budget. And then what we generally estimate for a rental increase is about 3% on an annualized basis. And then when we plug in our home purchase, we're going to go ahead and just estimate a home purchase. So if I'm looking at a condo or a townhouse, those purchase prices will, of course, look a little bit different. Let's go ahead and plug in, now, of course, this depends on where we're going to buy in the Bay Area, but let's go ahead and plug in 600,000 for now. Now, when we look at purchasing at that level, the minimum down payment is 3% for a conventional loan. We're going to talk about loan programs in just a bit, but it's just a minimum 3% down payment. We're also going to plug in property taxes. Generally, we're going to add in 1.25% in our calculation for property taxes. So we'll take 600,000 times 1.25%. When we buy a home, we also have homeowners insurance. So we have $1,000 budgeted here. So that's give or take in the ballpark. And then we also want to carve out maintenance costs. So depending on the age of home that we purchase versus a new home versus a resale, we may have maintenance costs that we want to carve out in our budgets. And then when we look at loan information, I'm going to add in a 30-year fixed mortgage. We're going to learn a little bit more about this later on tonight. Average interest rates, they kind of ticked up this week. We're going to just say 6% as a baseline. Origination charges, that's the cost that we're going to have in our financing. Generally, lenders are going to have a processing fee and an underwriting fee. With our team here at American Pacific Mortgage, we have a $910 processing fee and a $995 underwriting fee. And you're going to hear a little bit more about our partnership discounts later on. We have certain universities we partnered with, as well as for state employees. We have discounts of up to $750 on some of those origination charges. Discount points, in case you haven't heard of what discount points are, what that enables you to do as a consumer is to buy a lower interest rate. And we're going to talk more about interest rates in just a bit, but a discount point is usually equal to 1% of our loan amount. So if I was to finance, let's say $500,000, 1% would be $5,000. That $5,000 is used to buy down the cost of my interest rate. Now, the last section here is other settlement services. Now, that's part of the overall closing cost to purchase a home. Settlement services can be like title and escrow fees, government transfer charges, like transfer taxes. Those are all going to be under closing costs. Usually, closing costs are going to be anywhere between 2 to 3% of our sales price. That's kind of how we want to maybe budget that for our out-of-pocket expense. The next thing we want to look at is appreciation. We're going to go ahead and put 3% for now. I'm going to put 7 years in the home. And then selling costs. That's an important part to look at as a first-time home buyer, because when you purchase a home and you utilize the services of a realtor, you don't have to pay the commissions of a buying agent that represents you. That's actually paid for by the seller. So we always encourage, especially first-time buyers, to utilize the services of a realtor. So when you eventually sell that home, you will be responsible for those selling costs. But right now, as a buyer, you would not have those commissions as one of your expenses. We have state and federal taxes, and then a savings rate. Okay, so what this is going to do is going to take and look at our payments of renting versus buying. So of course, we know our rent's $2,500 a month, give or take. And then as a buy situation, we're going to go up to like $4,800 a month. But when we look at taking the total cost of renting versus buying over that span of 7 years, there's about a $22,000 opportunity on the buy side as opposed to renting. Now, where does that come in? That comes in with our appreciation, comes in with our tax benefits. Of course, if interest rates come down lower or if our appreciation rates are higher, then that number is going to look much more favorable on the buy side. But we want to be realistic in how we budget out for our potential home purchase. But clearly, over 7 years, I'm going to obtain equity. I'm going to have those tax benefits. They're all going to lead to creating more savings. When we think about that budgeting for a home purchase, really, and this calculator hopefully kind of shows that it's not really an apples to apples comparison. So if I'm going to map out a $2,500 rent payment with a $25 mortgage payment, those aren't going to have the same benefits when I think about the appreciation and tax benefits of owning a home in that future asset, right? So this is a kind of an important exercise for us to go through as we're developing kind of our home buying plan. And this is one of the things we'll help you out during our consultative process. Okay. So again, that's the rent versus buying calculator. I'm going to kind of keep us moving now. And I want to now spend some time talking a little bit about the housing market. For those of you that are joining us from the Bay Area, you have seen some changes in the housing market. What's leading to a lot of that? We have limited inventory, but given the interest rate environment that we've seen in the preceding 2 months, we've seen homes stay on the market a lot longer. But what I'm seeing right now in conversations with some of our preferred realtors, now we're starting to see more multiple offers starting to come out in the properties. So we're seeing less inventory, but now demand is starting to creep up. So you can see we have 28 days as the average days on market right now across the Bay. I imagine that number is going to look a little bit different next month because we are seeing multiple offers now, 3 and 4 offers. Now, if I was to kind of go back to, let's say, spring of 2022, in that segment of the market, what we were seeing is 20, 30 offers on homes. Rates were still in a decent position, but higher demand. Part of it was kind of the seasonality of the housing market, because we'll see more activity in spring and summer buying months. But at the same time, interest rates were at lower rates. We had a much higher demand. Now with the market changing, we've seen prices drop a little bit due to, a little bit less demand. And inventory levels again have changed a bit. But now, given we're kind of starting to go back into the spring buying months, we're probably just a little early for that, but we're starting to see buyers getting out in the market. Rates have now hit that 6% level. Hopefully they're going to fall below 6%, and that'll probably create more buyer activity. When we look at the last two years of home appreciation, clearly over the course of the pandemic, we saw record highs of appreciation leading or fueled by high demand in the housing market. We had unprecedented lows of interest rates going below 2.5%, and that really fueled this housing market. Now, as we moved closer to the 7% level in interest rates, we really saw the housing market start to slow down quite a bit. Now, what's driving interest rates today? Well, when we look at what the Federal Reserve is doing right now and ratcheting up the federal funds rate, which I think is what hit 6.75, that is obviously having an impact on overall interest rates. Now, the work that the Federal Reserve is doing to combat inflation right now is not necessarily a direct correlation to where interest rates have gone. So when we saw the Federal Reserve Chairman announce the 0.25% increase in rates last week, actually interest rates on the mortgage side went the other way, because we all expected the 0.25% rate increase to happen. So what happened with mortgage rates is we saw them actually come down to almost the mid 5s last week. But then Friday came along, the jobs report came out, employment numbers looked a lot better than everybody expected. And then interest rates, because of that signal in the market, interest rates went up this week back to the 6% range. So we have a very kind of choppy market, as I would call it. But nonetheless, when we look back at the last 2 months where we're at the 7% level, we've definitely come down a lot further from that. I think as we look forward into the markets, if inflation continues to tame, we should see interest rates start to come down more. My thought is we'll probably land somewhere in the mid 5s to low 5s this year. I think the big variable is, if there's any recessionary concerns as an economy. So, as I think we're building home buying plans going forward for our clients, that really kind of that 5.5% range, maybe 6% is where we'll see probably interest rates land. Now, as we kind of wrap up with interest rates, I want to kind of draw your attention to this, especially in our high cost of living markets. We get a lot of clients that inquire about interest rates and the selection of looking at a 30-year fixed mortgage versus an adjustable rate. And right now in the market, there's an inverted yield curve currently where long-term rates are intersecting short-term rates. So you just don't really have the value add or a really strong return on investment of going adjustable rates versus long-term fixed rates like a 30-year. All that being said, especially as first-time home buyers, we encourage really a 30-year fixed mortgage because it's just much more predictable for our first-time buyers. And if you do elect to utilize any of the assistance programs, it will always be a 30-year fixed mortgage product. Now, what goes into interest rates? Because not all interest rates are the same for all of our clients looking to purchase. There's a few characteristics that go into what makes up an interest rate. So it's credit score. It's going to be the type of product we're utilizing, how much we finance, what our down payment could be. So if I put 3% down versus 20%, that's going to influence my available interest rate. We talked really briefly this evening about discount points. Discount points allow you to buy down your interest rate. So if market rates are 6%, but I really want a 5.5% rate, I can pay additional costs to bring down my interest rate, also known as points. 1 point usually equals 1% of our loan amount. So if I finance $500,000, that 1 point is $5,000. The term of your loan, so if a 30-year loan, 20-year, 15, 10, even a 5-year loan, the lower term you have, generally the lower interest rate you'll be able to have as an offering. Okay. Now, as we do consultations with our clients and design that home buying plan, we're going to have that conversation around budget to figure out what term makes the most sense. And of course, interest rate selection, given the market conditions and kind of how you'd like your financing constructed. Now, a big part of interest rate is going to be credit. And generally, if you have a 740 credit score or higher, you're going to be able to get the best available interest rate. So as we coach our clients through their home buying plan, we're going to talk a lot about credit because credit's going to be really important to achieve that optimal interest rate. When we look at the FICO score calculation, I want to kind of draw your attention to the weighting of a FICO score. And many of you have various monitoring plans that you have, whether it's through Credit Karma or Experian, Equifax, or TransUnion. But there is a mortgage score that we look at to evaluate qualifying for home financing. Here's what the weighting looks like. So 15% of it's going to be how long I've had credit. 20% is going to be how much new credit I'm trying to access. So if I establish a new account or if I have hard inquiries, that's going to have a 20% weighting on my score. 30% is going to be how much I owe on my revolving credit. So we really want to manage down our revolving credit balances. That's also known as credit utilization. So if I have a $10,000 credit limit in credit cards and I'm at $5,000 on my balances, that means I'm at 50% utilization. My goal kind of to optimize my credit score is to have that utilization be below 10%. So let me give you a quick tip on how to kind of manage utilization. So if you look at each one of your credit cards, you have a due date, and then you also have a billing cycle date. Now, if that due date is on the 4th of the month, but if you look at your credit card and the cycle date is the 25th of the month, the 25th is when that cycle ends for your credit card. And that date also includes when the credit card company is going to send out the data to the credit agencies as to what your balance is and, of course, what your pay history is. So a tip to kind of take away from tonight's class is if you can pay down that balance before the 25th or pay it off entirely, that's the balance that's going to report out to the credit agencies and then give you a decreased utilization and hopefully a higher credit score. So that's a great way to manage your credit card debt. The last weighting is payment history. Of course, that's basically how you've paid your bills. Usually credit delinquencies are rated in 30-day lates, 60-day lates, and 90+ delinquencies. So that carries the most weight for the credit scoring. So when we've had any past challenges, it's generally going to have the most impact in the most recent 12 to 24 months. Now, every loan program has a minimum credit score. So we're going to talk about programs in just a minute, but FHA loans have a minimum score of 580. The conventional Fannie Mae Freddie Mac product is 620. VA loans is a 620. So for our veterans that have served and have VA eligibility, it's a minimum score of 620. And some of the first-time buyer programs that we're going to talk about in just a minute is 640 on an FHA loan, 680 for the conventional product. Okay. Now, one thing I wanted to point out to you, with your management of your credit cards, if you're in the habit of doing balance transfers and then maybe closing out that old credit card, really encourage you to be careful with that, because when we look at the maturity of your credit file, when you close out a credit account, we see the 15% length of credit history. When I close out a credit account and all that history that I've had, if I've had a credit card for 10 years, that gets pulled out of the credit model and could potentially drop your credit score. So you want to be careful when kind of managing, balance transfers or anything like that. And in the mortgage lending industry, we always take the middle credit score of the three agencies for your evaluation of eligibility. Okay. So what does that look like? So if I have a 700 score on, let's say 760 score on TransUnion, my next score is 740 and my lowest score is 720. The middle score is going to be 740. So that's what we're going to use to evaluate our eligibility. Now, if I decide to apply with my partner and my partner's at 720, 700, and 680, the 700 score is the lowest middle score between both of us. So in evaluating qualifying, now would be based upon the 700 credit score. So as we work with our clients and have them on that path towards homeownership, we're going to review credit items and see what areas of opportunity exist to hopefully optimize your credit and hopefully help achieve the lowest available interest rate and the best program that fits your financing needs. Now, when I look at credit and some of the negative items that may appear on a credit file, here's kind of a matrix to help you understand how long it'll stay with your credit. As I mentioned earlier, usually in the most recent 12 to 24 months, it's going to be the most impactful to your score, but this is how long those items will stay with you on your credit. So one of the things that comes up quite a bit as we work with our clients is student loans, and having student loans right now, especially federal student loan debts, we all know that they're in forbearance right now as part of the CARES Act in the pandemic and aren't set for repayment for several months. And there is potential student loan forgiveness that's forthcoming that's still making its way through legislation. That being said, in applying for a mortgage, we do still have to count the existing student loan debt into the qualifying. So what does that look like? Well, if I was on an income-based payment on my student loans prior to the pandemic, we are going to use that payment for the qualifying of the student loan debt today. Now, if I'm back in school or and I have my student loans on deferment or whatever the case may be, I still have to have a monthly payment counted for the qualifying. So whether that's an income-based repayment amount, like we have in our example on the screen, or if you haven't set up an income-based repayment and you don't plan to, the default payment is going to be 0.5% of our outstanding balance for an FHA loan. And if we're looking at a conventional Fannie Mae, Freddie Mac loan, it's going to be 1% of our balance. Now, in some cases, in fact, I met with a client earlier today and she's doing a conventional loan. She has a 0 payment. That's what she had as her income-based repayment because of her income level. If that truly is what our clients have, then that's the payment we use for qualifying. Okay. But again, right now, because of the forbearance, we still have to count a minimum monthly payment when it comes to the student loans. Okay, so let's take a look at some of the core programs available to us as buyers and first-time buyers. So these are kind of 5 of the core products we usually work with, and they all have little characteristics to them that can help support clients with their goal of home ownership. So there's the conventional loan, FHA, VA loans, USDA, which are going to be for more of our rural areas in California. So some of our desert communities down south. For our Bay Area, it's going to be kind of more up north in probably as you get towards like north of Vacaville, Williams area. And then for our jumbo loans, those are going to be for clients that are financing over $1,089,300. Just this year, well, every year, Fannie Mae and Freddie Mac update their minimum loan amounts or maximum loan amounts, I should say. And in the Bay Area, we can now go up to $1,089,300. So let's kind of talk a little bit more about loan programs. So for the conventional loans, you heard me mention Fannie Mae and Freddie Mac. So that's when we think about those loans, that's kind of the terminology we use. For conventional loans, the minimum down payment is 3%. As long as we stay under a loan amount of $726,200. Now that's what we call the conforming limit. So every year those limits get updated based upon the cost of living. And so $726,200 is the conforming limit. However, I can go beyond that limit, but when I do and go all the way up to $1,089,300, the minimum down payment jumps from 3% to 5%. Okay, so that's on a conventional loan. And as we heard earlier, the minimum credit score on a conventional loan is 620. Now for FHA loans, we have a minimum score of 580. The minimum down payment is 3.5%. Now there is no distinction between the conforming limit and high balance when it comes to FHA. You can go all the way up to $1,089,300. It's still that 3.5% down payment. Now we're going to talk about mortgage insurance in just a bit. And we're going to do a little bit of a comparison between conventional loans and FHA loans so you can see what that looks like. But when we think about FHA loans and conventional loans, we can go all the way up to that $1,089,300. In previous years, the maximum was, I think, $921 in 2022. So this is a pretty big jump up for the loan limits. Okay, I'm going to answer a question really quick on air. And the question is, if you have student loans, but they are going to be forgiven within the next 1 to 2 years because of the federal public interest loan forgiveness program, do you still have to factor those into the debt to income ratio? So the answer is yes. If we're applying now, we still have to factor in student loans. So from some of our clients that work in like in public health too, that have forgiveness, we still have to, today we have to count the existing balance. So. All right, let's talk again more about loan programs. So for our VA loans, those are going to be for our veterans that have served. There's no minimum down payment required on a VA loan. VA loans, there really is no maximum loan amount. Right now at APM, I think we're even going up to $2 or $3 million for VA loans. And for a veteran that serves, they will have a DD 214 that we would submit to the veterans VA portal that basically tells us what their eligibility looks like, and we receive back a certificate of eligibility, or also known as a COE. And then our USDA product, again, is going to be for more of our rural areas. That's 100% financing, no down payment required. For our jumbo loans, those are going to be for clients that need to finance more than $1,089,300. Now, with a jumbo loan, it usually requires a minimum down payment of 10 to 15%. When we look at the assets required for a jumbo loan, it's going to be a little bit more extensive because not only do I have to save up that 10 to 15% down payment, but I also need to have money for my closing costs because there won't be any assistance programs available for jumbo loans. And they also require reserves. What reserves are is an amount of assets that I have left behind that usually are 12 months of the equivalent of my monthly payment. That's an additional assets that I retain. So let's say I have a $6,000 mortgage payment and it's a 12-month reserve requirement. That means I have to have $72,000 set aside in an asset account beyond what I have set aside for my down payment and my closing costs. Now, all that being said, for most of our first-time buyers, the first stop in home ownership is probably not going to be a jumbo loan. More than likely is going to be a conventional or FHA product, but we're certainly here to help support our communities with the jumbo product. It's probably going to be more of the second or third time purchase for most of our buyers. Now, I told you we would talk a little bit about conventional and FHA loan PMI comparison. So when we look at conventional loans, PMI is going to be based upon a few characteristics. So it's going to take into consideration credit score, my down payment, and then how much I finance. So it's kind of a risk factor that gets computed through the mortgage insurance companies. Now, there's different ways to pay your mortgage insurance. Traditionally, it's done through a monthly premium included into your monthly payment, but you can also split that up. You can actually split it up monthly. So some of it monthly, some of it upfront. You can buy out the mortgage insurance, which is called a single premium. So it gets factored into your closing costs. You can also include it as a lender paid mortgage insurance. And what that basically means is you're taking a slightly higher interest rate in order to buy out the mortgage insurance. So let's say my interest rate today without the buyout is 6%, but I want to elevate my interest rate to buy out mortgage insurance, then maybe my interest rate goes to say 6.75%. That's not an option that a lot of clients elect. And really because interest rates are higher than they have been in the past, it makes more sense generally to do monthly mortgage insurance. And the reason why I say that is because PMI on a conventional loan does have a cancellation option. So generally when I have 2 years in my loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. Now let's look at an example. I know this loan amount may be a little bit low for some of us, depending on what our purchasing budget is. But if we look here at the bottom left-hand corner of the screen, let's say I have a loan amount of $450, my credit score is 740, and I'm putting 3% down. If I look at the mortgage insurance calculation, I'm probably going to be paying about $183 a month. Now, if I put more money down or have even a higher credit score, then that mortgage insurance premium could come down potentially. Okay. So that's what conventional mortgage insurance looks like. Now, if I look at an FHA loan, it's going to be a little bit different. And here's where that looks different. Mortgage insurance is going to be the same regardless of my credit score. So it's going to have two components of mortgage insurance. It's a 0.85% factor of my loan amount for the monthly component. And then I also have upfront mortgage insurance, which is usually 1.75% of the loan amount. So that 1.75 gets added on to my amount finance. One of the big things with FHA loans is the mortgage insurance cannot be canceled. It only can be canceled through a refinance. So in essence, what I would have to do is refinance out of my loan and then go into a conventional product. So now let's look at that same loan amount on FHA PMI. So we have that $450 loan amount. The upfront mortgage insurance gets added on to my amount finance. So now am I not only financing $450, but now I have that additional upfront mortgage insurance. So now it's $457,875. And then my mortgage insurance monthly premium will go to $324.32. So about $140 more a month. So you may look at those payment scenarios and say, well, why would I ever choose FHA? And that's probably a good thing to look at. However, FHA is going to have different guidelines than conventional. So for our clients looking to qualify, not everybody qualifies for a conventional loan. FHA will generally be a little bit more lenient when it comes to past late payments. Obviously, you heard earlier, the credit score minimums are lower. There's a little bit just overall more leniency within the FHA product. So when we design home buying plans for our clients, we'll usually look at both programs and see what makes the most sense for our clients, given some of their home buying goals. Okay. Let's talk about some of the documentation and center that around kind of employment for your home buying plan. Usually for W-2 wage earners, we're going to need the last 30 days of pay stubs, your last 2 years of W-2s. I mean, you just got your W-2, so just a week ago, so that should be readily available. We're going to do verifications of employment. Now, for self-employed, we're going to need a little bit more in terms of documentation. Usually we'll need the last 2 years of tax returns, probably a profit and loss statement, and then we'll need to verify the business through either like a CPA letter or even a business license. Now, there's a couple misconceptions out there that I always like to bring to the attention of our classes to make sure we kind of just make sure you get the right information. Oftentimes, clients will come to us thinking that they need at least 2 years of employment history to buy, which just isn't the case. You can, and the example I use often is if you've just graduated, let's say you did a 4-year degree in accounting and you just started a job just last month, that 4 years of education can qualify for the 2-year requirement. There's a 2-year education or work requirement in home mortgages. So even though I've just started my job, I still would meet the requirement because I have my past educational history that supports my career. Another question comes up is that if you're transitioning jobs, so let's say I work for one agency today and I have a job offer for another, do I have to wait till I'm, settled on that job before I can qualify for a mortgage? And the answer is I can qualify you with as little as an executed offer letter to be able to use the new earnings to qualify for your mortgage. So that's a really great kind of, option for you as a future first-time buyer. As long as you're going to get your first paycheck before your first payment is due on your mortgage, then we can use that future income for that new job. When you have dual employment, we see this a lot in the healthcare industry. So if I'm working 30 hours at one clinic, 30 hours another place, as long as I can show that I've simultaneously worked at both places for 2 years, or I've shown a history of that over the last 2 years, then we can use both sources of income for qualifying. Now, if I have maybe a side business, let's say maybe I drive for Uber, but I also have W-2 wages. If I can show that I've done both jobs simultaneously for 2 years, then both sources of income are allowed in qualifying. So those are some of the examples that we typically look at or that we share during our classes. Is there any questions I can help answer around documentation or income for home buying? Okay. One other question I just want to add, or one thing that comes up in classes, just a couple of things. One is rental income. Can we count rental income for our home buying eligibility? So on first-time buyer programs, you can't count future income like room rents or anything like that. If you're looking at there's some alternative programs that we offer where if you've traditionally rented a room out and you plan to do that at your new house, that could potentially be used as future income. The other question that comes out is if I have a partner that, has a source of income of, let's say, $5,000 a month, can that get added to the total income equation? It can't get added unless that partner is added to the actual mortgage application. So we can't count any ancillary sources of income unless it's part of the actual application. Okay, so sticking with income, I want to talk to you about an equation I think somebody actually mentioned in the chat just a little bit ago, which is debt to income ratio. Really simple calculation. It looks at your pre-tax income versus your monthly obligations, credit card debts, personal loans, student loans, car loans, and then we're also going to factor in the new mortgage payment. Generally, we don't want the debt to income ratio to be more than 43 to 45% of that pre-tax income. So here's what the calculation looks like. So we'll take the principal, the interest of the loan, we'll take the property taxes of the house, the estimated homeowner's insurance. Now, if we're putting less than 20% down, we're going to add the PMI component in. And then if you're buying a condo, townhouse, some single family homes will have HOAs or homeowners association expenses. So if we take that total sum of payment, let's say it's $3,500 a month. If my other debts are $500 a month, then my total obligations are $4,000. And if I have monthly income of $11,000, that means my debt to income ratio is about 36.3%. Now, most of our first-time buyers feel comfortable around 33 to 36%. The guidelines in financing will, in some cases, allow you to go all the way up to 50%. Not ideal, but I do understand some of the clients we work with have income that we can't necessarily document, and that's totally understandable. it's our goal to make sure that we design a home buying plan that's going to be affordable and sustainable for you. And so that's one of the things that we do as we kind of meet with our clients during our consultation, is kind of show them what our debt to income ratio looks like, I should say, and then how that can, necessarily impact their qualifying, just make sure that we're buying in a good position. The last component to home buying is on the asset side, basically our down payment. So what we've heard so far is, credit, we've looked at income, we've looked at kind of programs, and the last kind of ingredient to our home buying plan is down payment. So these are some of the acceptable sources that we can use for down payment. So of course, our checking and savings account, cash deposits that enter your account are not allowed for financing. We do have to paper trail everything. Every asset used has to be sourced for 60 days, or sorry, seasoned for 60 days. So if we have a large deposit, let's say I just got my tax return, that's easily traceable because I can trace it back to the US Treasury. But if I had a $5,000 deposit enter my account, I need to figure out or understand where that came from, right? Retirement accounts can potentially be used, 401ks, 403bs, IRAs. With IRAs, you could create a tax situation for yourself. So you want to make sure you talk with your financial planner, your tax advisor. Usually with 401ks, 403bs, you're going to take a loan out against those assets to be able to utilize. We try to steer away from using those assets if possible. And so, but if needed, they can certainly be used for home financing. And then the last section of this down payment slide is going to be around gift funds. That's where family members can help out with your down payment or closing costs. Those are assets that do not need to be seasoned the 60-day requirement. So those assets can be transferred over right away. There's no requirement around that. Generally, we're going to need proof of the donor's bank statements and the transfer, and they'll have to complete a gift letter. Usually, in some cases, the donor can send the money straight to escrow, and then there'll be less of a paper trail of funds. Now, when we build home buying plans for our clients, there's usually kind of two things that can be maybe challenges or hurdles to achieving home ownership as one of their goals for this year. It can be credit, because just maybe we have high utilization or maybe some past challenges, or it can be just lack of resources around down payment. And more so from the clients that I meet with throughout the day, it usually comes around down payment, having enough savings. Maybe my landlord just recently told me they're going to sell the house, and now I have to scramble to figure out how I come up with my down payment. Or, I'm tired of renting. I want to, buy something, and, maybe I'm not totally prepared for that. So the first-time buyer assistance programs are wonderful tools to help you achieve home ownership, maybe a little bit earlier than you expected. So we partner with CalHFA, which is the California Housing Finance Agency, to help both low to moderate income households achieve the goal of home ownership. So we're going to talk a little bit about some programs that are available today to you, and then programs that are set to launch in the future. And so we'll kind of give you a high level of what those look like. The first program is My Home Assistance, which provides up to 3% on a conventional loan and assistance. On an FHA loan, provides 3.5% of your sales price and assistance. And what these are low interest loans at 1% simple interest that you do not have to pay back to the state until you either sell your home or if you refinance in the future. So it sits there as what we call like a silent second. And then when one of those events occurs, selling or refinancing, then you would have to pay back at that time. So that can help, as you remember from our loan programs part of tonight's class, that can cover the minimum down payment for a conventional loan as well as an FHA loan. There's also help that's available for closing costs through the ZIP assistance program or zero interest program. And it truly is zero interest. So you can get up to 2 or 3% of your loan amount, zero interest free from the state to help with closing costs. Now, in this market right now, the ZIP assistance program hasn't been as favorable for our first-time buyers, because what happens is if you elect to add the ZIP assistance on top of your home buying plan, it does elevate the interest rate. So we encourage our clients, if you can save up your closing costs, it's a more favorable for you. But the interest rates offered through the first mortgage through CalHFA are really super competitive. In fact, just last week, we were able to help clients achieve rates as low as 5.6%. So it's a great program. Those interest rates do change every day. Here's an example of what this would look like as a conventional loan using one of these first-time buyer programs. So as we talked earlier, with a conventional loan, the minimum down payment is 3%. So if we bought a $450,000 house, the minimum down is $13,500. And then generally I estimate 2 to 3% of our sales price for closing costs. So that would be like $9,000 to $13,500. So more than likely, I'm probably going to need about $22,500 to $27,000 total out of pocket to achieve homeownership at that $450,000 level. Now, if I was to look at the assistance programs through CalHFA, I can leverage that My Home 1% interest loan of $13,500 to help offset my minimum down payment. So in theory, all I would have is my closing costs out of pocket of $8,700 to maybe $13,000. So that makes homeownership much more achievable for us. Now, if I did need to add the ZIP assistance, I could do that. And that obviously would help lower those out of pocket even more. So most of our clients right now that we're building plans for, we're going to take advantage of just the My Home Assistance Program to try to optimize that interest rate and lower the total out-of-pocket expense. These are wonderful programs offered through the state. Now, that's what we have available today through the state. But in the next couple of months, we're going to be launching a new program, which some of you may have even heard of already. It's called the California Dream for All. And what this program is going to do for California first-time buyers is to enable you to be able to get access to a 20% down assistance. So it's 20% of your purchase price in assistance. It's set to be a 0 interest rate loan that would also not be required to be paid back until you either sell the home or if you refinance in the future. There may be an opportunity to, and I just mentioned sell or refinance, but there may be an opportunity to refinance one-time exception if your interest rate drops below 1% on a refinance, to not have to pay back the full 20% at that time. Some of this information is all subject to change because it is based upon some of the state guidelines coming out, but this is kind of at a high level what the program could look like. The 20% can be used for down payment or closing costs. And again, it's not forgivable. There is one characteristic to this program that's a little bit different than some of the other assistance programs we've helped with over the years, because it does include an equity share agreement. And what that equity share agreement states is that as my home appreciates over time, the state would share in up to 20% of that equity growth. So if I bought my house for $450,000 and then the equity grows to $550,000, the value goes to $550,000, that means I've had $100,000 in appreciation. The state would share in 20% of that, which would be $20,000. So when I sold the home, I would pay back my 20% plus that 20% equity share. So there is a little bit of a trade-off in this program because the other programs don't have the equity share component. But the opportunity to be able to put down 20% versus maybe 3% or 3.5% is a significant difference. And some of the early calculations we've done for clients, it's changing payments anywhere between $600 to $700 a month. Obviously, depends on what sales price and amount finance the client has, but it's a significant change. So we're excited about this program, getting ready to launch. We're going to, as we get more details of the program, we're going to be posting on our social channels. And we're teaching California Dream for All info sessions. We do have one in a couple weeks. So as we get more information, we're going to try to bring that to our local communities. Okay. Just to give you a quick example of what that looks like for the California Dream. If we bought that same house for $450,000 here, you can see the 20% assistance you would get would be $90,000. You could also take and maybe use a portion of that 20%, maybe put 17% down and then use the other 3% for closing costs to be able to, facilitate potentially no money out of pocket. We're going to talk more about kind of the home buying process because there will be some out of pocket expense to expect, but the California Dream product is certainly going to make things much more feasible for many of our first-time buyers. Now, there is income limits for first-time buyer programs, but as you can see across the Bay Area, there are pretty significant limits. So they're generally 150% of the median income. So the highest limits we have are in Santa Clara and Marin County and San Mateo. The other counties are at 282. If you're looking to purchase in other counties across California, they'll adjust according to cost of living. If you're right here in Sacramento, the maximum income here in Sacramento is $202,000. Here's some of the other eligibility requirements with the CalHFA assistance. It's a minimum score of 640 on FHA, 680 on conventional loans. The debt to income ratio that we just reviewed is a maximum of 45%. However, if I'm a 700 credit score or better, we can go all the way to 50%. This program's a little bit different than other local first-time buyer programs offered through city and county agencies, because we only look at applicant income. We don't look at household income. So for example, if I make $150,000 a year, but my partner makes $200,000 a year, and that takes us above the Bay Area income limits, if we are able to qualify in just my income, then my income is the only income used to qualify under the program. And a first-time buyer is someone that hasn't owned in the last 3 years. Okay, so even if I've owned a house, like we had a client that owns a house on the East Coast, but's been traveling for the last 3 years and resides here on the West Coast, that person is still a first-time home buyer because that property is no longer their primary residence for the last 3 years. And this program is eligible for single-family homes, new construction, condos, townhouses. There is BMR programs or below market homes that the program is also eligible on as well too. Some BMR programs that may be a little bit more difficult with CalHFA. I know in the city of Hayward, some of the BMR properties can be a bit challenging, but please contact us for more details on a particular community that you might be interested in. Manufactured homes are eligible, but they do have to be on land that is owned. All right. I gave a lot of information, and hopefully, it's things that are kind of getting the thought process going around home buying and how much more achievable it can be for you. I want to walk us now through the home buying process. We call this our 6 steps of home buying. And the first step in the process is going to be the pre-approval. And the pre-approval is the output of a consultation with us. That kind of signifies to a seller that you're certified and eligible for your financing. The pre-approval is generally good for 60 days, but we can always recertify your pre-approval at any time. And that pre-approval kind of gets us out now to step 2, which is house hunting. And you're going to get a chance to do your search online. You're probably going to partner with a realtor. Realtors, as we heard earlier, are paid for by the seller. We do have preferred realtors we work with. So, if you want us to connect you with one of them during your home search, we're more than happy to make that introduction. Now, as you're looking at homes, several of our clients are looking right now, and you find a house that maybe is different than your pre-approval amount, we can always update your pre-approval to match your offer price, just as long as it's lower than your maximum eligibility that we came out of with your consultation. Step 3 is going to be entering escrow, and that's an exciting time because now your offer has been accepted by a seller, and it starts the escrow process. From step 3 to step 6, it's usually about 30 days before I get the keys to my house. So if my offer was accepted today, February 8th, then technically I'd be the owner on March 8th. Now, escrow time periods can be as short as 21 days, but right now in this market, about 30 days is typically what we're seeing. Now, I mentioned to you earlier that there is some out-of-pocket expense with purchasing a home, and that comes to play with the earnest money deposit. An earnest money deposit is usually 1 to 3% of our sales price. It's basically a good faith deposit that we make in the escrow to start the escrow process. And that money gets counted towards our total out-of-pocket expense. Now, once your offer is accepted, we're going to be giving you a call within at least 24 hours of that accepted offer to schedule you for your follow-up consultation. And that's where we get a chance to meet with you one-on-one to go over the design of your home financing, talk about interest rates, your out-of-pocket expense, what the steps in the process are going to look like going forward. We're also going to order the appraisal of your property, and your realtor is going to help order any inspections that you desire on the property. And the output of that follow-up consultation will be to send your initial disclosures to you that highlights all the attributes of your financing. Here's what the earnest money deposit looks like. Again, it's 1 to 3%, I would say. I know the slide says 1 to 2%, but in the Bay Area, we do oftentimes see that you have to elevate your deposit to 3%. That money is protected while you're in what we call the contingency period. And the contingency allows you to do your due diligence on the property. Usually it's in the first 14 to 17 days of the contract period. If I look back at, the Bay Area market, 5-6 months ago, oftentimes buyers weren't able to get contingencies in place with negotiations with sellers. But since the market has switched to more of a buyer's market, we're seeing buyers able to do their contingencies, and like the appraisal, which ensures the property is going to appraise for what I'm buying the house for. We get our inspections, make sure there's no potential pitfalls in the property, and then of course getting the loan approved. So now that we have more of a buyer's market, really allows our buyers to really kind of do their homework on the property. Now, step 4 is going to be the processing and the underwriting of loan. That's kind of more of the behind the scenes administrative work that we do. We get everything ready to go to our underwriting team. And our underwriting team is going to issue an approval, and that usually happens at step 5, but also brings us about 3/4 of the way through the escrow process. Because by that time, once I have had a loan approval, that also means that I'm at the end of my contingency period. And so if everything looks good for your loan approval, your appraisal comes back and it supports the value or the purchase price of the house that you're buying, we're almost at the finish line, and we're going to issue to you a final closing disclosure that's going to give you a 3-day cooling off period before we get to the very final stage, which is called closing your loan. And that's at step 6. And everything that you receive as far as from a disclosure perspective is all done electronically. But when we get to step 6, we do have to do an in-person appointment with a public notary. It's still that way right now. We may see some e-notaries at some point, but currently right now it's all in person. At that time, you'll also wire in any of your final funds that are owed as part of what we call the cash to close. That money gets reconciled along with your mortgage funds that get wired into escrow and any assistance programs that you elect. Once that money gets reconciled and balanced by what we call the escrow team, we'll get acknowledged that everything balances, and then documents will get recorded with the county recorder's office. They usually record a grant deed that transfers ownership to you as the new owners. And they also record a deed of trust, which is your agreement to repay the loan. And so once we get confirmation of both of those items being recorded, then you become the official owner of the home, and we get a chance to celebrate. We give you the virtual high five, and we get a chance to celebrate this huge accomplishment. You're going to connect with your realtor to get the keys to your house and get a chance to move in and let the fun begin. After you get your keys to your house, the relationship doesn't end with our team. We make sure we stay connected with our clients. We enroll you in what we call the HomeBot system. HomeBot was going to go ahead and kind of update you on your market value of your home. It's also going to share with you when interest rates change. In fact, we have a new program that we just launched called the Buy-Fi program, which allows you to, if you purchase before April 30th, and you refinance before December of 2024, allows you to refinance your home with no lender fees at all. So it's a really cool program. Many of you may not be ready for that quite yet because you're just attending a class in February and may not be ready to buy in April. But if you're a little bit earlier in kind of the goal of homeownership, that might be helpful for you. Now, you've heard me mention about consultations earlier. A consultation's basically either a video or a phone call that we do with you to be able to kind of go over a home buying plan with you. And to start that process, you'll submit an easy online application. You upload documents. Now, during our application review, we only do a soft credit check, so you don't have to worry about your credit being impacted at all. And after tonight's class, if you're not quite ready to start doing a consultation, we'd love to be able to connect with you for an introductory call. That just allows us to maybe answer some follow-up questions that you've had from the workshop, or maybe go through a particular situation, or maybe talk more about your homeownership goals, whether it's next month, next year, or maybe 2 or 3 years beyond. We just love connecting with our clients to help build those home buying plans. It's interesting, as of late, we're talking to a lot of our clients that connected with us and build home buying plans in early 2022, because as we talked about earlier, the market was super competitive and interest rates didn't really help support our buyers. But with the market starting to shift to a buyer's market, I can't tell you how many buyers from 2022 that didn't purchase are now coming back around saying, wow, you know what, there's a cool opportunity out for us in our local communities. So here's what a consultation looks like for us. This is kind of the framework of buying. So we're going to do a budgeting exercise. We're going to look at the locations because that's going to influence obviously your purchase price. We're going to go through the debt to income ratio calculation, credit. We may have to talk a little about some of your income statements to make sure we meet the qualifying. But at the end of the day, the output of that consultation will be hopefully to have you pre-approved and start that journey towards homeownership. This is one of our resources that's available to you. It's our mobile app. In fact, you can start the buying process or the qualifying process right through mobile. It's available for Android and Apple. There's also some great calculators on here. So as you're searching for homes, you can use the calculators And there's some great, terminology that's available, so you can look up different terms on the app as well. So great tool for you to take advantage of. You heard me talk a little bit about partnerships. So we're really grateful to be able to partner with these wonderful universities across the country. So part of that partnership for alumni includes a $750 discount, as well as all the different, programs we offer to our clients. And if for our state employees as well too, we offer the same type of discount. So, we really want to be your trusted mortgage advisor in this process. And we really try to do that by adding, value added information through some of our educational classes, but making sure that we're connected with you through the home buying process. We understand this is going to be one of the biggest investments you make in your financial future. So we want to be there connected with you to help support you along the way. So with that said, that kind of brings me to the end of tonight's class, but I do want to open it up for Q&A and just let you know, this is all my contact information too. So if you do need to reach out to me, feel free to message or call me. Love to be able to get connected with you. Before I forget to, I love what our clients say about it, especially on our Google and Yelp reviews. Many of our clients have come right from classes that we've taught over the last 7 or 8 years. Great testimonials you can find on those reviews, as well as on our Instagram. We like to share a lot of our testimonials with our communities. Any updates we have on programs, especially with the launch of the California Dream program, we share on our Instagram. So we encourage you to follow us at JMeda Mortgage on Instagram. We try to put a lot of good content out there to help support our communities in homeownership. So with that said, I'll open it up for Q&A if we do have any questions before we wrap up to tonight's class. Okay, and if we don't have any questions, that's okay too. We can always take some questions off the air too. Okay. All right. Well, we'll tell you too, we teach classes about every week too. And so if you found this information helpful for you on your journey towards homeownership, you can invite friends, family, coworkers to attend one of our free classes. Our entire class schedule for 2023 can be found at mortgageeducate.com. I know we have a class next week, and then we have our info session with California Dream later this month. Okay. All right. Thank you so much for attending tonight's class. I really hope to get connected with you soon. Have a wonderful evening, and we'll see you soon.